Most people treat wealth like a fortress. They pinch pennies, clip coupons, and aggressively build a wall around their savings to protect it. But hoarding money actually blocks new wealth from entering your life. To grow your net worth, you have to treat your dollars like little soldiers. You deploy them onto the battlefield to work independently and capture more ground while you sleep. I learned this before being voted the top angel investor in Canada. This strategy let me co-invest with Google founders and cultural icons like Jay-Z. Today, the strategy has evolved. Buying AI stocks is a passive move. The active advantage comes from using these models to manage the capital you already have. When you treat AI as an operating system rather than a speculative asset, you gain access to research and oversight capabilities that used to require a full staff. Before you turn the AI on, there is one non-negotiable rule. You can only deploy capital into industries where you already have an unfair information advantage. 15 years ago, I bought a package of extremely cheap homes in Detroit. I wasn't deeply integrated into that specific real estate market, and 18 months later, I was stuck with properties that were essentially unrentable liabilities. Compare that to a check I recently wrote for a company developing embodied AI robotics. I live and breathe artificial intelligence. I know the core players, the underlying technology, and the trends. It's a calculated decision, not a blind guess. Even the greatest investors of all time adhere to this. Warren Buffett famously avoids complex tech sectors simply because he sticks strictly to what he understands. Artificial intelligence cannot replace your human intuition. It can only amplify the baseline of industry knowledge you already possess. Once you establish your sector, you hire your firm's first employee, the scout. An LLM prompted to spot hidden market opportunities before anyone else talks about them. If you want to invest in the AI boom, first-order thinking tells you to buy NVIDIA or Google. The problem is, that's what everyone else is doing. The obvious trades are already priced in. Instead, prompt your LLM to map the supply chain and adjacent industries, identifying second- and third-degree winners. The AI shows data centers require enormous power, meaning the real profit sits with commercial electricians and copper suppliers. During a gold rush, you want to be the one selling the shovels. Your AI scout generates the math to exactly where those shovel stores need to be built. Finding a good idea is half the battle. Next, you pass it to the crash test dummy. This is where you instruct the AI to brutally tear your investment thesis apart, without ego or mercy. You run a red team command. You tell the model what asset you're buying, and you demand the top 10 brutally honest reasons you will lose all your money. I recently prepared to fund a personal finance AI app. I had capital ready to go. Then I ran it through the stress test, and the AI flagged that major tech companies were highly likely to launch identical features natively. I would have been crushed by big tech. Your job is to take those 10 fatal objections and actively solve them. You have to confidently answer every single one before you wire a dollar. Surviving this diagnostic test strips away emotional excitement, refining your idea into a mathematically defensible strategy. Finally, we bring in the air traffic controller to solve the biggest mistake investors make, deploying capital and then completely ignoring it. Most people have money scattered randomly across brokerage accounts, their real estate, and side businesses, with absolutely no unified oversight. Fix this by feeding your asset list into an AI like Claude. Instruct it to build a live dashboard that constantly measures the health of every position, tracking real-time signals and automatically pinging you if any valuation drops 10%. As Peter Drucker said, what gets measured gets managed. Automated AI monitoring ensures your portfolio is actively primed for growth rather than left to rot. The era of the lucky stock picker is fading. The next decade of wealth belongs to system builders. The highest rewards will go to those who know how to collaborate with large language models to outmaneuver the rest of the market. It comes down to 3 pillars: commanding AI to discover hidden opportunities, using it to red team your weakest assumptions, and automating the oversight of your money. So pick a sector you deeply understand. Run the worst-case scenario prompt tonight, see what breaks, and then prepare to deploy your capital with actual confidence. By delegating the grunt work of research and monitoring to a system, you ensure your money is being watched as closely as you worked to earn it.